5 reasons I quit passive index investing. I'm Mitch, the founder of Strong Wealth. We manage over $30 million, and I used to recommend passive index investment portfolios for my clients. But it wasn't until I understood these 5 things that I'm about to share with you today that it completely changed my mind, and I completely quit passive index investing altogether. So before I get to the 5 reasons of why I quit passive index investing, I want to share this meme because it's one of my favorites. You can see here the guy on the right, the guy on the left, they both think the same. They can beat the market. And this is IQ score across the bottom on here. So this is implying that people with a high IQ and a low IQ, they don't overthink. They know that they can beat the market. But the guys in the middle, which is the majority of people, they're the ones that are shouting from the rooftops that you need to be a passive index investor because no one can outperform the market, especially over long periods of time. But after I share these 5 things I'm about to share with you, I think you'll disagree with the guy in the middle. All right, number 1, passive investing leaves you stuck at the mercy of the market. You can see across the top here. You have no mechanism for adaptation or downside protection. Your portfolio is like a fighter with his feet stuck in concrete. He can't duck, he can't dodge, he can't attack based on what the other person is doing. What if inflation is historic? What if the dollar loses reserve currency status, which I believe we're seeing right now? We just saw historic inflation in 2022, 2023, after they had that big money printing in 2020. What if bonds no longer protect portfolios like they used to? I'll get into that here in just a second. What if we see a flat decade in US stocks? We've seen it before. What if the market takes 34 years to recover? This has happened. Passive investing treats all markets the same, assumes the future will look exactly like the past, except while also claiming no one can predict the future. Sounds silly, doesn't it? Let's continue on. Next, different regimes reward different assets. In the 2000s, the S&P 500 delivered negative 0.95% annualized returns. That was the lost decade. If you remember from the last slide, what if we get no returns over a decade in US stocks? That happened in the 2000s. Negative 0.95% annualized returns, while international stocks thrived. $1,000 in emerging markets grew to nearly $2,000, which would be a 100% return over that time. In the 2010s, it flipped though. The Morningstar US Market Index gained 12% annualized, while the Morningstar Developed ex-US or international stocks gained only 4.6% annualized. Also during the 2000s, gold shined, returning 393% over the decade. However, through the 2010s, gold returned only 6.7%. So as you can see, different regimes in markets reward different assets. And so what most passive indexers, what they recommend is, well, we don't know what the next, regime is going to look like, what assets are going to win in the next decade, if you will. So let's just own all of them. My argument against that is why not have a strategy that can just adapt to what's performing and take advantage of what assets might be performing over certain decades? What if we had a portfolio that could take advantage of the international stocks in the 2000s and gold in the 2000s and ignore US stocks? And then it could shift in the 2010s away from gold, away from international stocks into the US stocks again while they perform better. What if we had a portfolio that could do that? Continuing on, the 60-40 safety net failed when you needed it most. So what if bonds don't protect your portfolio? They didn't in 2022. In 2022, the S&P 500 dropped 24%, while the Bloomberg US Aggregate Bond Index fell 16%. And it still hasn't recovered. The peak that we saw prior to 2022, it has not gotten back to that peak yet, which is absolutely wild as we're 5 years later at this point. This is the longest bond bear market in history. The worst bond market performance in history. For the first time since 1969, both stocks and bonds posted significant losses together. Bonds failed as a hedge precisely when inflation spiked and the Fed hiked rates, proving passive indexing fails when conditions change. Next, real-world consequences. Japan's lost decades. Japanese investors who bought at the 1989 peak waited 34 years to break even. The market recovered eventually, but their retirements didn't. This happened in Japan, not in the US, but who's to say it can't happen in the US? What if we had a 34-year market drawdown? 34 years it takes for the market to recover to reach another new all-time high. We've never experienced something like that in the US. The 2000s is really the closest thing that we have to compare it to, and that's only 10 years. But what if it's 34 years? What if that happened and you're entirely invested in US stocks, or you have a portfolio that's heavily passive, indexed to US stocks? It might have some other stuff in there, but if a large chunk of your portfolio is going to be, struggling like this, what if you had a portfolio that could adapt right here? What if you had a strategy that could adapt, positioning you to take advantage of these market shifts? All right, let's continue on. Number 2, relative strength outperforms buy and hold. I'll get into what that means here in just a minute. But passive indexing rests on a single premise. That premise is that markets are so efficient that no strategy can consistently outperform. However, Eugene Fama, the father of efficient market hypothesis, which passive indexing, a lot of the research done in the proponents for passive indexing, they based it on the foundation that the market is efficient and that you cannot consistently outperform the market, which is what was the thesis of Eugene Fama, who actually came up with that hypothesis in the first place. So he has called momentum the biggest embarrassment to the theory. He admits the godfather, if you will, of the efficient market hypothesis, which all passive indexing rests on. He admits that it's broken. It's broken. It's not true. He says momentum is the biggest embarrassment to the theory, adding, "I hope it goes away." His own doctoral student, Cliff Asness, confirmed Fama has never been comfortable with the finding, if past price movements do predict future returns, then markets are not fully efficient, and the intellectual case for surrendering to an index collapses with it. You can see here, momentum is a big embarrassment for market efficiency. I hope it goes away. Cliff, his doctoral student, it is obviously a result that he's never really liked. So he's the one who did the research on momentum strategies and found that, these type of strategies can outperform, which is what I'm about to get into here in just a second. All right, diving into it. So these two charts or tables here that you see are from a paper written by Meb Faber. What he's showing is that the relative strength strategies can outperform buy and hold over time. So relative strength strategies, I'll get into what those are in just a moment. But this first table here, you can see from 1928 to 2009, this is U.S. equity total returns. If you have the S&P 500, 9.39% compound annual growth rate and a max drawdown of 83% over that time. If you had an equal weight portfolio, so if you looked at the 10 sectors within the U.S. equity markets and you just equally had 10% of your portfolio in each of those sectors, it would have performed 10.28%, and the max drawdown would have been 81.67%. So as you can see, already outperforming the S&P 500, which is what most passive indexers say should be, the biggest bedrock of your portfolio. But continuing on, relative strength strategies give us even more outperformance and lower downsides. So what this is showing here in Exhibit 4.5 down below, that 12-month relative strength portfolios can outperform. So what is a relative strength portfolio? Well, this data specifically was a analysis run by Faber. He said, okay, if we just look at what sector has performed the best over the last 12 months, and we hold that sector only in our portfolio for the next month, and then every single month, we just rerun the analysis. Every month, we look back over the 12 months, whichever sectors perform the best, that's the one we hold. If it's the same one we held last month, great, we continue to hold it. If it's a different one, we switch. So very simple. Whichever sectors perform the best for the last 12 months, that's the one we hold for the next month. And we just rerun that analysis every single month. That's very easy to do. Very simple. So over 1928 to 2009, you can see here that if you just held the top performing sector for each given month, your compound annual growth rate would have been 16.05% over that time with a max drawdown of 76%. So you can see here, significantly outperforms the S&P 500 with a better max drawdown, a lower, or I should say higher max drawdown, if you will, if you want to think about it that way. So your portfolio did not drop as much as the S&P 500 over this time frame. You can see here that as you continue to add in more sectors, if you held the top 2 sectors every given month, your CAGR drops a little bit and it continues to diminish returns as you get to the overall equal weight portfolio. So, it's better to concentrate on the best performing sector, and that has shown to give you better performance, over just buy and hold the S&P 500. So relative strength, all it's referring to is what is the highest sector that has the highest relative strength among all the other sectors or compared to the other sectors. So the one with the highest performance over the last 12 months, that's the one we hold. We rerun the analysis every single month, and that's what these numbers are showing. This is nearly a 100-year period that we got strong outperformance over the S&P 500 of 16%. If your argument is that no one can outperform the S&P 500 over long periods of time, no one can outperform the market over long periods of time, not true. This data shows that nearly a 100-year period, we can consistently outperform the market. I don't have the other table in here. I should have put it in here now that I think about it, but there's another table that shows outperformance by decade, and every single decade outperforms the S&P 500. So pretty straightforward. It's obvious to me, and this is clear proof, academic research that proves that you can easily outperform consistently the market over time, over long periods of time, just with a simple strategy that doesn't require you to, pick stocks or day trade or anything like that. So continuing on here, the dollar impact is staggering. So if you just look at this difference in outperformance of 9% CAGR versus 16, here's what that would look like in your portfolio over a 20-year period. Assuming you had a starting balance of $2 million, you invested that for 20 years and you earned a 9.39% compound annual growth rate. Your ending balance would be around $12 million. At a 16% compound annual growth rate, your ending balance would be $39 million. That's a $27 million difference just from holding the highest performing sector instead of the whole market. This is a very easy strategy to implement. If you didn't watch the rest of this video, this alone shows you that you could very easily outperform the market just by implementing this type of strategy in your own portfolio, which it's not hard to do now that we have a lot of ETFs available that specifically, invest you in specific sectors instead of just holding the S&P 500 in general. Which brings me to my next point. No stock picking or day trading required. You simply rotate in whichever broad sector is leading. The passive indexers never mention this. Nobody who's an advocate for passive index investing, they never talk about this simple strategy that can outperform the market over, long periods of time and do it consistently. All right, continuing on here. Absolute momentum outperforms buy and hold. So we have relative strength portfolios outperform buy and hold. I'm going to show you a different type of trend and momentum investing that outperforms buy and hold as well. So this research was done by Gary Antonacci. This is an absolute momentum strategy that's also very simple, very easy to implement. So all that this is looking at, instead of comparing the relative strength of a specific investment compared to other investments, this is just looking at the investment itself and saying, okay, in this first column here, for example, U.S. stocks, if we just owned the whole U.S. stock market, all right, and the only decision that we're making is we look back over the last 12 months. If the U.S. stock market has outperformed treasuries, then we hold the U.S. stock market. If we look back over that time and treasuries have outperformed, then we hold treasuries. Very simple. You just look back every single month. At the first of the month, you look back over the 12 months. If U.S. stocks have outperformed treasuries, that's what you own. If treasuries have outperformed U.S. stocks, that's what you own instead. And so what the data shows then is a simple absolute momentum strategy like that you could very easily implement yourself, gives you a higher percentage of profitable months from 1974 to 2012. You can see here, and This applies also. One thing I want to point out is the profitable months, percentage of profitable months. Not only is it true for US stocks, you can see the darker green bar here is the momentum strategy versus buy and hold in the light green. So you get higher profits in US stocks by utilizing that simple approach, but it also applies to all of these other asset classes as well. Look at this: international stocks, treasury bonds, credit, high yield bonds, real estate investment trusts, commodities, and gold. Consistently, the dark green bar is higher than the light green bar. This works across all these other asset classes as well. Very simply, look back over the last 12 months, whichever's performed better, T-bills or the asset class I'm looking at, that's what I hold. And I just rerun that analysis every month. Very simple. So not only does it give you outperformance to the upside, so higher growth, it gives you better downside performance as well. This is like a no-brainer. Look at this: maximum monthly drawdown from 74 to 2012 as well. Not only did you get higher profit, you got lower drawdowns. Instead of having a negative 50% drawdown in US stocks, you had a negative 23 or somewhere in there percent drawdown in US stocks. Half. It's a lot easier to hold over long periods of time when your portfolio's drawdown is half as much as the asset class itself. And this isn't some complicated strategy. This isn't trying to time the market. It's completely data-driven and systematic. If you just follow the rules, you'll be able to get similar results. Continuing on, you can see here, better drawdowns in every single asset class. Not only did you get higher returns, you got better drawdowns. That's the best of both worlds. Continuing on, this is just more proof that momentum outperforms buy and hold. Here's John Lewis. He wrote the paper Relative Strength in Portfolio Management in January 2010. There's been so much research showing that momentum works that academics no longer dispute its value as an investment factor. I'm just trying to show you guys that this is not something that I am just coming up with. I'm not just reinventing the wheel here and coming up with some novel strategy. This is something that's proven to work for a century. And so it's like, passive indexers always want to say, well, there's not enough data to be able to, switch my strategy. I'm just going to continue to hold this specific allocation for the next 20, 30, 40, 50 years. What? There's 100 plus years of data showing that this strategy can work better. Continuing on, Paul Tudor Jones, one of the best hedge fund managers, he said in 2022, if there was a strategy that I want to employ right now, if someone put a gun to my head, I'd say simple trend following strategies. They're not too popular today. They will probably do very well in the next 5 to 10 years. Why are they not too popular today? Because everyone wants to be a passive index investor instead of actually looking at the efficacy of these strategies and how that can give them better performance, both to the upside and the downside. Continuing on, AQR research firm, trend following investing has performed consistently over more than a century, as far back as we can get reliable return data for several markets. I don't know what more proof you need. All right, number 4, the fourth reason why I quit passive index investing is because the dollar is crashing. Now, I don't say this to be an alarmist, to be somebody that predicts the collapse of the US dollar tomorrow. It might take a long time. It might be death by 1,000 cuts, but I fully believe that the end of the dollar, the end of fiat money and the dollar as the reserve currency is coming to an end, and we're living through it right now. It doesn't mean that we're going to wake up tomorrow and everything is going to be in chaos. These things happen gradually over time. All right. Why do I believe this? M2 money supply has exploded. This is just a measurement of the overall money supply in the US. So M2 has expanded from approximately 15 billion in 1913. This is when the Federal Reserve was created, to over $22 trillion today. During COVID alone, M2 grew at record rates, 26.9, almost 27% year over year in February 2021. So over the last 20 years, we've seen 6 to 7% growth rate in M2. So if your portfolio is not performing better than 6 to 7% after taxes, after fees, all that stuff, you are underperforming inflation, in my opinion. And we only see this ramping up over time. The money supply increase is only growing faster over time. Second point here, interest payments are now the second largest federal expense. The national debt has grown so big that now just servicing the debt, just paying the interest on the debt, is the second largest expense of the government. Interest on the debt hit $1 trillion in fiscal year 2025 and has grown by 15.9% annually over the last 10 years. Imagine that. The interest alone has grown by 15.9% per year over the last 10 years. At this rate, interest alone is expected to equal total tax receipts by 2042. Let me just put this into perspective really quickly. If this was you in your financial situation, what this is showing here is that your total interest, let's say on your credit card, for example, just the interest alone on your credit card equals your income. Imagine if that was the case. You're bankrupt. There's nothing you can do. You can't pay off your debt because the interest alone takes up all of your income. You have no other income for other stuff that you need. You're completely bankrupt. That's what's supposed to happen, or that's what we're on pace to hit by 2042 in the United States. I think things will break before then, but at this point, all the tax receipts that we would receive would go straight to interest, nothing else. That means everything else that the government's funding, their own salaries, education, Social Security, Medicare, all this other stuff, that would just have to be newly printed money. Newly printed money is where that would come from. Third point here, federal budget deficits are at all-time highs. Fiscal year 2025 recorded a deficit of 1.8 trillion. Fiscal year 2026 is on pace for 2.4 trillion, which would be an absolute record by a long shot. Interest plus mandatory spending are now closing in on 100% of tax receipts and growing by 9% per year over the last 3 years, meaning there's no wiggle room, and printing money is their only politically acceptable solution. So what I'm saying here is interest on the debt and mandatory spending. This is Social Security. This is healthcare, Medicare, all the stuff that they committed to prior, and they can't really make changes to unless, if they do make changes to it, there probably is going to be a lot of unhappy people. So they're very unlikely to actually make changes to it. That is almost 100% of tax receipts. So that means that there's no wiggle room to cut down the spending. You can't get on a budget now and, get underneath your actual, spend less than you earn if you're the US government. You can't do that. There's no wiggle room whatsoever. And the only thing that you can do is just print money to get out of it and hope people don't notice. But what that printed money leads to, which is what we saw during COVID, when we saw the highest record rates in money supply growth, was massive, historic inflation only a year or two later. So this is only going to grow. It's only going to keep compounding on itself, because the more that the interest grows, the more that mandatory spending grows, it just blows out the deficits. It makes the deficits larger, which adds to the debt, and the debt increases the interest expense over time. So you can see this is just a snowball rolling downhill, and it's like an endless hill with endless snow. So it's only going to continue to get bigger and bigger over time and cause the value of the dollar, the value of your dollars, to completely diminish over time until it's just completely irrelevant. I don't know what the timeline of that looks like in our world, but I do know that you do not want to be on the wrong side of this. All right, more evidence as to why the dollar is crashing. There's a supply and demand imbalance that exists in the U.S. Treasury market. Fed Chair nominee Kevin Warsh hints at yield curve control. Hedge funds have been among the largest marginal buyers of U.S. Treasury bonds. So what we're seeing here is that, and I'll show you another point here in just a second, but foreign nations are not buying our debt. They're not buying our treasuries. So who's going to buy the treasuries? AKA, who is going to fund the government? Well, Kevin Warsh, the latest Fed chair nominee, is calling for a Fed Treasury Accord. What that means is he just wants to work together. The Federal Reserve with the U.S. Treasury, he wants to work together to fund the government. That should be a huge alarm bell to you, to your financial advisor, whoever's giving you financial guidance, whoever you're listening to. This should be huge, huge warning signs, okay? Yield curve control, what that effectively is is the Federal Reserve printing new money to buy US Treasuries to fund the government. So basically, all we're doing now is we're a complete Ponzi. We're printing money to fund the government, printing money to fund the government. All that's going to do is, again, continue that snowball downhill. It's brand new money, higher inflation. You get where I'm going with this. So the new Fed chair nominee, he's not even in there yet. He's not even in the seat yet. He's already preparing you for what he's going to do, and that's print new money. All right, we can see here that hedge funds are one of the largest net buyers of U.S. Treasuries, and this is from the Federal Reserve itself, telling you this. So why does that matter? Hedge funds, they're borrowing a bunch of money, they're levering up to buy U.S. Treasuries, again, just to keep the U.S. government solvent. When that unwinds, it looks very ugly, which is why we get a lot of volatility, not only in the bond market, but in the stock market and other markets as well. And that's only going to continue to exacerbate over time. And you can see here, this is from the day I actually recorded this from just a few minutes ago. You can see this post on X. China has instructed banks to begin selling and limit purchases of U.S. government bonds amid concerns that U.S. debt may expose banks to sharp swings. I don't know what else you need to see. The writing is on the wall. And if your financial advisor isn't talking about this, or you're a DIY investor and you're just a passive index investor, or you have a guy who's managing part of your portfolio and you're doing part of it yourself, these things, again, are flashing warning signs that you need to make some intelligent changes to your portfolio to protect yourself and take advantage of the time period that we're living through. Because the dollar is crashing. I don't know how fast. You're not going to wake up tomorrow and it's going to be gone, but it is crashing, and it's only a matter of time before the inevitable happens. Continuing on here, the S&P 500 is down compared to unprintable assets. Again, this is why I'm not a passive index investor anymore. I want performance in my portfolio. And when you look at the S&P 500, it looks good on the surface. When you denominate it in dollars, it looks good, but dollars can be printed. So maybe it's just the printed dollars that are making this look good, and we're not actually gaining wealth over time. We're just keeping pace with inflation, which I would argue is what the S&P 500 is doing for you. That's all it's doing. It's not actually growing your wealth. You're just treading water, and this is proof of that. Here's the S&P 500 since 2000. You can see it looks, oh, wow, we went up and to the right significantly. That looks amazing, doesn't it? And if you're riding this the whole time, you feel like you're getting wealthier and wealthier. But if we denominate the S&P 500 in gold, something that can't be printed like dollars, it looks a lot different. You can see here, down, 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 down we go. I don't know. Just something to think about. And I know that most financial advisors, most financial planners that are proponents of passive index investing, they don't own any gold. I know that most DIY investors that are proponents of passive index investing, they don't own any gold either. They just hold, the S&P 500 fund, maybe some international, maybe some bonds in there, all that stuff, but they don't own any commodities. All right. But if you look here, simply owning gold has given you substantial outperformance over the S&P 500 over the last 26 years. Continuing on, S&P 500 since 1971, S&P 500 compared to gold since 1971. You can see here when we're tracking the S&P 500 in dollars, looks really good up and to the right. Woo, there we go. That looks amazing. Now, if we track the S&P 500 in gold, what does it look like? Down since 1971, down, flat to down. We had a big spike in 2001, dot-com bubble, but here we are up here around 2.5, 2.5 back in 1971. Now we're at 1.38 S&P 500 gold to gold ratio. I don't know. I mean, I think this speaks for itself that when you actually look at the S&P 500, not in dollar terms, but in other terms, in assets that can't be printed, it's flat to down over long periods of time. And this is ever since President Nixon took us off of the gold standard back in 1971. So once he gave the free green light to go ahead and print money, essentially, The S&P 500 looks really good in dollar terms, does not look so good in gold terms. Continuing on here, we look at silver as well. Same thing, S&P 500 looks real good compared to silver. Okay, we're about flat since 1971. Still had the same spike here. We had a little spike here, but we're flat over that time. And I would very much, I would venture to guess that your financial advisor or you, if you're a DIY investor, you don't own any silver. Continuing on, S&P 500 since 2020, S&P divided by Bitcoin since 2020. So we're denominating in dollars here. Oh, it looks really good. We had the COVID crash, but it's, we're up about, well, look at that. I mean, we're up, I don't even know, from 2,500 to almost 7,000 on the S&P 500 over that time. That's pretty crazy performance, but that's in dollars. We compare it to Bitcoin, down. It's down over that time. So when you compare the S&P 500 to unprintable assets, doesn't look so good. You're not getting the real performance that you think you are when you're owning these assets. And imagine, I'm showing you the S&P 500 compared to these assets. What if I showed you bonds compared to these assets? What if I showed you international stocks compared to these assets? It's all going to look the same. Bonds are going to look even worse. I would imagine international stocks would probably look worse for these timeframes as well. But story remains the same. This is why I'm not a passive index investor anymore. I don't believe it's the best approach. I used to be that. Like, I really did. And people paid me for my investment advice. I managed portfolios for people. And now I manage it in a better way. Why is this happening? Why are we seeing this with the S&P 500 versus gold? Well, you can see here the dollar's role in global reserves is withering away. The black line is USD in global reserves. The gray is gold. So you can see these other fiat currencies, they're trending down. Dollar's trending down. Gold is trending up. Nation states, they see the writing on the wall. They're buying gold. They don't want to be exposed to dollars anymore. They don't want to own U.S. debt. Back to my point earlier. They want to own something that can't be printed. That's why they're buying gold. So you can see here 2025, we also have 2024 and 2020, our top 10 annual return years for gold since 1970. 2025 was a 65% return in dollar terms. 2024, 27%. 2020, 25%. All right. So we're seeing some of the best returns in gold ever. And this is why, because the dollar is crashing and people, intelligent investors, smart money, they want to own assets that can't be printed. So why did I quit? Well, there's a few reasons. I was tired of getting mediocre results in my portfolio. I was tired of being stuck at the mercy of the market. I wanted a strategy that adapted to the market to give me better returns and could protect my downside. It didn't feel right to me that we were just sitting idly by, letting our portfolio just get whipsawed all over the place and not doing anything to adapt, not doing anything to take advantage of opportunities that we clearly saw that other people were taking advantage of, that other people were using to get better performance than I was. I realized that trend and momentum investing can provide better returns with less downside without requiring me to pick stocks. So this was always my argument. I shouldn't try to time the market. I shouldn't pick stocks. That's risky, because I thought that was the only other alternative. But once I found this systematic, data-driven way to outperform consistently over decades, it's a no-brainer. Last, the almighty dollar is losing its power and purchasing power every day, and that has created obvious opportunity for intelligent investors. Bottom line, I wanted to help my clients retire earlier, spend more in retirement, and have peace while doing it. If your portfolio is not growing, outpacing inflation, it's treading water over time, and again, it might be going up in dollar terms, but you can't just compare how many dollars you had yesterday to how many dollars you had today. You have to look at that compared to inflation, compared to other assets that can't be printed like the dollar can. So what should you do instead? What do I do instead? Well, I made a video going over our investment strategy named Fluvius. It's a dynamic investment strategy that actually gives you the adaptability, the growth that you want while protecting your downside and still providing diversification. It's not picking stocks. It's not day trading. It's not trading options. It's none of that. It is a simple, systematic way to get consistent outperformance over long periods of time. And I'm breaking down the strategy for free in that video. So go watch our proprietary investment strategy, Fluvius, to learn more about it. And then if you want to reach out to me, schedule a call to discuss if this portfolio strategy might be right for you. You can go to our website, www.strongwealth.net. I wish I would have had the .com, but someone else beat me to it. Strongwealth.net. You can schedule a call to talk more. If you feel like you need to make a change in your portfolio, if you feel like you need to make a change away from your advisor, if you just need to do something differently, if you want to retire earlier, spend more retirement, and actually have peace that your portfolio is taking advantage of opportunities and it is adaptable over time, it's flexible, you're not just at the mercy of the market, we can help. Thank you for watching. Go watch this video to learn more about a strategy that can solve these problems for you.